Welcome to the Indian stock market full analysis for the 11th of August 2026. This is a complete post-market report covering Nifty, Bank Nifty, sectors, options, and the outlook. Let's begin with a clear picture of how the market closed today. Closing snapshot for Tuesday, 11th August 2026. Nifty 50 closed at 24,471.70, down 112 points or 0.46%. Sensex settled at 78,154, down 388 points. Bank Nifty closed at 57,446, down 241 points. India VIX fell to 11.79, showing that volatility remains in the complacency zone. Mid-caps were flat, while small caps managed a small gain of 0.2%. Market breadth was negative, with only about 13 out of 50 Nifty stocks ending in the green. Why the market fell today? The primary driver was a sharp spike in crude oil prices, combined with geopolitical uncertainty. Brent crude surged toward $89 to $90 per barrel, while WTI traded near $84. Hopes of a United States-Iran deal to reopen the Strait of Hormuz faded after President Trump demanded compensation from Iran, and Tehran maintained its own conditions. This prolonged the uncertainty. India is the world's third largest oil importer, so higher oil raises the import bill, increases inflation risk, and puts pressure on corporate profit margins, especially in energy-sensitive sectors. Weak global cues and weekly F&O expiry volatility added to the selling pressure. As a result, Nifty closed below the important 24,500 zone and stayed under the recent consolidation lows. Global cues in institutional flow. United States markets closed lower amid Middle East energy worries. Asian markets were mixed, and Japanese markets were closed for a holiday. Risk-off tone dominated risk assets worldwide. On the institutional side, FIIs remain net buyers with plus 705 crore rupees on the 11th of August after strong buying of almost 2,000 crore the previous day. DIIs turned mild net sellers of around 412 crore. The rupee weakened to 95.44 against the US dollar, the day's low, as oil strength and risk aversion put pressure on the currency. Overall trader sentiment remained cautious, but not panicked, with focus on the crude trajectory and defense of the 24,400 level. Crude oil shock and why it matters. Oil prices rose more than 2% as negotiations over the Strait of Hormuz hit an impasse and Brent tested the $90 zone. The impact channels on India are clear. First, higher current account deficit risk through a larger oil import bill. Second, rising inflation expectations that could make the RBI more cautious. Third, corporate margins get squeezed in FMCG, auto, aviation, and cement. Fourth, rupee depreciation adds further imported inflation pressure. The market reaction was textbook. Energy-sensitive and high-beta sectors sold off first, while pure defensive and export-oriented names such as pharma and IT held relatively better. Until oil stabilizes or a clear diplomatic breakthrough occurs, this remains the key overhang for the near term. Nifty 50 support and resistance levels after the break of 24,500. The index closed at 24,471, with an intraday low near 24,429. Immediate support is at 24,400, which had earlier attracted heavy put open interest. The more critical zone is 24,340 to 24,300, which is the prior breakout area and the 20-day EMA zone. A decisive close below this can open the path toward 24,200 and even 24,000. On the upside, resistance starts at 24,500, the psychological and previous max pain level that must be reclaimed. Next comes the strong call writing wall at 24,550 to 24,600, followed by 24,650 to 24,700. The broader higher top, higher bottom structure remains intact as long as 24,300 to 24,200 holds, even though short-term momentum has turned weak. Bank Nifty support and resistance. The index closed at 57,446 after recovering from an intraday low near 57,158. Support is placed at 57,300 to 57,100 near the 50-day EMA, which is a strong buying zone. Next support is at 57,000, an important put base and psychological level, followed by 56,800 to 56,500, the lower end of the broader consolidation channel. Resistance begins at 57,800 to 58,000, where heavy call open interest sits. A breakout zone for trend resumption is 58,100 to 58,300, with targets at 58,600 and 59,200 if that level is taken out decisively. Importantly, Bank Nifty showed better recovery from the lows compared with Nifty, indicating selective institutional support in banks, despite pressure on private banks during the day. Derivatives picture covering open interest, put-call ratio and max pain. For the weekly Nifty expiry that ended today, the put-call ratio stood around 0.72 to 0.73, indicating a mildly bearish bias because of more call writing than put writing. Max pain was at 24,500 and the index closed below it, which is a negative signal. Highest call open interest was concentrated at 24,500 and 24,600, acting as strong resistance. Highest put open interest was around 24,400 to 24,300, forming the support base. For Bank Nifty monthly contracts, max pain is near 58,000. PCR is around 0.80 to 0.90, and the call wall at 58,000 remains intact, with put support visible near 57,000 to 57,500. Overall interpretation is that option writers were defending the 24,500 to 24,600 zone. Closing below max pain and the call wall keeps the short-term bias cautious until fresh open interest builds in the new weekly series. Who led the fall, Nifty or Bank Nifty? Nifty fell 0.46%, while Bank Nifty fell 0.42%, making Nifty the slightly weaker index on the day. Major drags on Nifty included private banks and financials, such as Axis Bank and Bajaj Finance. FMCG names hit by margin concerns from higher oil, metals, realty, select auto and cement stocks, and heavyweights such as Bharti Airtel. On the other side, Bank Nifty showed relative strength. It recovered significantly from its day low near 57,158, and buying emerged close to the 50-day EMA zone. This suggests that institutional interest is still present in the banking space, even as private banks faced profit booking. Conclusion: selling was broad-based, but Bank Nifty held up better and showed constructive behavior near support. Sector performance: strong versus weak. Clear divergence was visible on the day. Strong outperformers were Pharma, which rose 1 to 1.02%, led by Dr. Reddy's with strong gains. IT, which gained 0.6%, with TCS and Infosys providing a cushion, and consumer durables, which stayed mildly positive. Weak underperformers included FMCG, which fell 1.17% and was the worst sector due to margin pressure fears. Realty down about 1%, metal down 0.95%, private banks down 0.6%, auto down 0.55%, and infra down 0.8%. Oil and gas was roughly flat to mildly positive, while small caps gained 0.2% and showed resilience versus large caps. Sectors that prevented a deeper fall. Two sectors absorbed significant selling pressure through defensive and export-oriented buying. First, Pharma, which rose 1%, led by Dr. Reddy's Laboratories on US FDA-related strength and biosimilar news flow, attracting defensive money into healthcare names. Second, IT, which rose 0.6%. TCS, Infosys, and peers provided a floor. Being an export-oriented sector, IT is less affected by domestic oil inflation concerns, and rupee moves can sometimes help. Together with resilient small-cap buying, these pockets stop the indices from breaking more aggressively lower. In a pure risk-off day, such relative strength is important for assessing market depth and investor preference. What to expect tomorrow on the 12th of August? The overall bias remains cautious to range-bound, with a mild negative tilt until fresh cues emerge. Critical triggers to watch are the direction of crude oil, which is still the dominant variable. the US CPI data that will influence Fed rate expectations and global risk appetite, any new headlines on the Strait of Hormuz or US-Iran talks, and stock-specific action including Tata Motors results and other earnings. Scenarios are clear. If Nifty holds above 24,400, a bounce toward 24,550 to 24,600 is possible. A break below 24,400 or 24,300 risks an accelerated move toward 24,200. Low India VIX suggests complacency, so any surprise can cause a quick expansion in volatility. Option buying opportunities in the new weekly series. Premiums are relatively cheap because VIX is low, but time decay and possible volatility expansion must be respected. If the view is bearish or for hedging, prefer 24,400 or 24,300 puts, or better still, bear put spreads to keep cost limited. If bullish on the support holding, wait for a clear reclaim of 24,500 to 24,550 with volume before considering call spreads. Avoid naked calls. For range-bound views, iron condors around 24,300 to 24,700 can be considered only with defined risk. For Bank Nifty, focus on the 57,000 to 58,000 zone for spreads. Always prefer defined risk strategies in the current oil and geopolitically sensitive environment. Summary and market bias. Key takeaways from the 11th of August. The primary driver was the crude spike plus Hormuz uncertainty. Nifty closed below the 24,500 max pain, signaling short-term caution. Bank Nifty showed relative strength near the 50-day EMA. Pharma and IT prevented a much deeper sell-off. FIIs continue to buy, and the broader structure remains constructive above 24,300 to 24,200 on a closing basis. Near-term bias is cautious and consolidative. Watch the 24,400 defense and crude oil closely. Medium-term remains constructive, while the higher top, higher bottom sequence holds, and FII flows stay positive. Risk management is essential because oil and geopolitics can change the picture quickly. Position size accordingly. Important disclaimer: this presentation is for educational and informational purposes only. It does not constitute investment advice, recommendation, or an offer to buy or sell any securities. Stock market investments are subject to market risks. Past performance is not indicative of future results. Always do your own research or consult a SEBI-registered investment advisor before making any investment decision. Data is based on publicly available information as of market close on the 11th of August 2026 and may change rapidly. Levels, PCR, OI, and max pain figures are approximate and should be verified on live option chains before trading. Thank you for watching.